Pennies Going in Raw is a production of iHeartRadio. The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy!
On this episode of Pennies Going in Raw, we discuss stock jargon, and stocks are back to going 1,000% plus.
You find out life's this game of pennies.
Oh, you guys know we only have a 40% runner. Hello, 40% is a fucking killing.
We've been compliant for too long. It's time we go to war.
I don't have a Roth.
Hugh knows so much about the market that his brain doesn't have enough room for grammar.
Hey, who told me about IDEX? It's going up a shit ton now.
Rob, 4%, baby. No way. 4 fucking percent.
You asked the exact same question with 2 words different.
It's like, man, I just got dick whipped for like 20%, and now that f***er's up like 50.
I bet Warren Buffett never did that.
I'm just making this voice memo to call out unusual whales to a fight.
The pennies we need are everywhere around us. Pennies.
Going in Raw.
Featuring Dan, Deity Dips, and Hugh Honey.
Produced by Vinny.
And Christian.
Let's go, baby.
Welcome back to another episode of Pennies Going in Raw. Today is Wednesday, August the 3rd. And I mean, SPY, it seems it's at this, we thought it'd be a pretty big week, and it still could be. But what are you kind of seeing out of SPY right now? It's still sitting around this 408 to 412-ish range, not making huge moves. I figured it would have definitely decided by now. But do you think it's waiting on something? Do you think it's just traders unsure?
Listen, if I were more geared towards like a swing, like options, blue chip kind of guy, I would go back and look at June. Right after FOMC, I would go back and look at June. I think it's really important to peek over there, because we are setting up almost the exact same. When we had that, and I'll look at the date exactly, 6/1, so June 1st to like the 8th, we had this tight range, and it's almost the same exact range as it was in June. And the funny thing is that the candles are pretty similar to June. Now, we obviously had a little bit of a rally back today, but if we had closed at lows today, and I'm talking like 407, like yesterday's lows, like 406, 407, that would have been almost the same exact setup as that June 7th. So the next thing that I'll be curious to look at is if the next 2 days are super green. Because if the next 2 days are super green, we are literally on the same exact algorithm trail. We are literally playing it to a T. And yeah, so I'll be really interested to see. Honestly, if I were a bull, I'd probably want the next 2 days to be pretty red to break out of this range, because we obviously know what happened last range. And like I said, is that if the next 2 days are really green and we're back up near 417, which again we were here 7 weeks ago. Then I'd be really concerned, and I'd be probably taking some off. But I think for the most part, most of this range is just to decay the options on both sides and set it up for the next move. Again, is that market makers have to pay out on options when there's large moves. So what's the way to do this? The way to not pay out as much is to decay the options to an insane point, so that even if people are right about the move, let's just say that you start holding it Monday, if you start holding like a weekly option on Monday, if the move doesn't happen until Thursday, no matter where the price is, you're at least going to be down 60, 70%. So this is a way that market makers can ensure that they're not going to, have to pay out too much. So again, is that I would be really cautious, if this range is pretty similar, and if this does set up like the last June range period that we had. I don't know what exactly to call it. Then I will be scaling it more into that SPY and VIX position. The SPY position is about even. The SPY short position is about even. The VIX calls are up about 37%. So, we'll see what happens. But, like I said, if I were a bull, I wouldn't want the next 2 days to be super green and follow that trend from last month.
All right. Well, if we're going into some more exciting things from this week, we saw stocks do shit we haven't seen them do in like over a year. We saw HKD, like a fintech startup, involves like the metaverse and shit from Hong Kong, went up thousands of percents. I think an interesting tweet from Stock Market News. HKD is currently the 45th largest stock in the world by market cap, larger than McDonald's, Verizon, Disney, Adobe. If you guys just look at it, let's see, HKD stock price. You press 5 days on it. July 29th, it was trading at $163, and on Monday it was at $2,500. It's back down to $1,600, but still, it's up 3,000% in 5 days, or in the past 5 trading days. Like, it was at 75 on July 28th. So it was up 100%, 200% the next day, 400% the next day. Is this like a small cap thing coming back, or is this just someone said, hey, metaverse, small cap?
This is going to end very, very, very badly. All right, not to toot my own horn because you guys do that for me, but this kind of reminds me of TRCH. If some of you guys are newer and you weren't there for this, the CEO and I had words. I was asking him questions about the share structure because I was long, and we were up a pretty good buck. We were up like 200 or 300%, and I asked him for the share structure, and his only reply kept being, "Oh, Hugh, come check out the manufacturing. Come check out the manufacturing." And there was like a little clause in there about basically they could sell as many shares as they want, after like a certain date. And I was like, listen, like, are you going to sell these shares? Are you going to sell these shares? And then we've ended up finding out later that part of the board and, some of the people involved had done this before. Where like, they would pump a company up and then smoke it. And this is kind of what this reminds me of, and I'll show you the numbers. So if you guys know Hindenburg Research, they put out a lot of short reports mostly, and AMTD, who owns 88% of this HKD, okay, they're a Hong Kong holding company, and they've kind of been in trouble before they've been in trouble before for taking shady IPOs to market. And so I'll just read some of the US listed companies that AMTD took, and their percentage performance since then. WEI, it IPO'd in November of 2018. It's down 98.5%. APM IPO'd in December of 18. Down 90.3%.
So essentially, you're claiming that these guys are just going in on these things where they have these cheerleader CEOs, and they're just gonna be able to share all their stock and just get a clutch short report in and make bank on it.
Yeah, I mean, at the end of the day, the way that most of these IPOs work is that let's just say the founders, everybody's giving founder shares at like $2, let's call it. And again, I'm not saying that this is exactly what happened. I'm just saying that this is typically, from what I've seen out of Hindenburg and what I've seen from other people, typically the way that works is that they'll get founder shares that, let's just call them like $15 a share. And then, when the company goes public, let's even say that it goes public at $5 a share. Well, even if they sell them right at that level, they're still making, double on their investment. So I'm looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. I'm looking at 15 stocks where the average decline since IPO is 73.4%. So what it basically looks like these guys do is that they bring these companies to market, and once they have, a good amount of shares at a pretty cheap discount, and then they basically, sell them for a profit once it goes public, and then they still keep a good chunk because again, they can't sell the entire company, but they'll keep a good chunk, which is why, again, AMTD owns about 88% of HKD. And now AMTD is about to have a really good quarter once they sell those shares. It's kind of like Q4 when Amazon had a bunch of shares of Rivian. And then, so on paper, Amazon had a fantastic quarter that quarter. And then obviously we know the last 2 quarters they haven't. But, same thing for AMTD. If they decide to, lock that profit, that's going to be a really nice quarter for them. So, but yes, essentially it looks like they bring these companies to market.
They're stat padding their earnings reports.
Yeah, pretty much. I mean, honestly, I might buy some AMTD before their next earnings.
I wish she could short these. I just wonder how volatile they'd be if you could just short them immediately as they.
That would be so crazy. Yeah,
it'd be like an actual tug of war.
But yeah, HKD is one of the more wild ones that I can think of inside the past decade for sure. And who knows how it goes. I haven't touched it. I haven't bought or shorted or went long a single share, and I probably never will ever.
I probably would have last week if I knew.
Yeah.
All right. Well, kind of getting into our topic today, back with our season 2. Before we get into our last section, we wanted to do some stock jargon. Obviously, one of the reasons we kind of started this is that they kind of gatekeep trading stocks. They make it seem like it's something super complicated that no one else can know how to do unless you're on Wall Street with 14 different monitors. But we kind of wanted to go over some of the stock jargon, some of the stock terms they use. And we'll probably break this down to a few Wednesday episodes. But we wanted to hop in on some of these. And did you want to kind of kick us off?
Yeah. So the first thing is a lot of people open up the brokerage and they want to get right to work. And they're like, what's the price? How do I buy the S&P 500? How do I buy the ABNB? How do I buy Tesla? And one of the first questions that I feel like we get asked pretty frequently is, what is the bid and the ask? Because again, you open up your brokerage and you don't know what the hell is going on because there's 2 prices. Well, technically, I guess there could be 3 prices at every time. So you have the bid, the ask, and the last price, which is obviously shown, to the world. And, the bid refers to the highest price a buyer will pay for a stock at that current second, minute, hour, day. So let's just say we're looking at the S&P 500, or let's take something smaller. Let's take Airbnb.
Yeah, something with that's trading all the time is always, it's usually going to be 1 cent. It's not going to be very different just because the difference in someone buying it and selling it's just so close and it's constantly changing.
Yeah, exactly. So let's just say Airbnb. Okay. Airbnb, the bid, so it closed.
Keep in mind, we are in after hours, so we'll be a little different.
Yeah, 116.34. Right now in after hours, this is actually perfect because you can see the difference between the bid and the ask. The bid currently is 105.25, and the ask is currently 105.50. And so we just went over the bid, which is again the highest price a buyer will pay to buy a stock. And so now it just moved up from 105.25 to 105.33. So now there's someone saying, hey, I'll bid higher. So it's the same thing like when you're buying a house. And, especially inside the last few years, typically they'll say, you have 20 hours to get in your highest bid and whoever has the highest bid wins. Well, this is on a second to second scale kind of thing. And so the flip side to that is the ask. And the
lowest
ask
price
is
someone's
the
willing
offer price
to sell for it. Yeah, sell for it.
Exactly. And so, and then of course you have the price that the stock is trading at, which would be the last price. So again, is that I like after hours, to really kind of get this concept, because it shows typically there's a larger difference between the bid and the ask. And obviously there's not as much movement. So, when we're inside the middle of the day and things are going buco crazy, sometimes,
right as the market opens, it's fucking
quick.
You won't be able to, unless you press print screen, you're not going to be able to see a damn thing.
Exactly. And so this is why, I think it's really important. And this comes down to, as your eyes get acclimated to all the busyness on the screens, this is something that you'll pick up a lot easier.
Hey, I think before we go on to another one, while we're on bid and ask, a good one to do next is level 2. Basically, it's just all the bids and ask in one little order book. It's like so if you want to see how many are on the bid, how many are on the ask, because, whenever we're going to talk about walls and resistance and stuff later, but you'll kind of see how they all kind of correlate.
Yeah, definitely. And that's a really good point, because it's kind of like a ladder system. So you can see, is it, let's just say so again, Airbnb, let's just say the bid is 105.25. Well, you can see the next highest bid. So different than probably real estate, where, everybody puts in their bid and then the highest one is accepted, and you just have to hope that you didn't overpay an exuberant amount. Inside the stock market, something that level 2 helps with is that you can see who the next highest bidder, or not necessarily who, but what price the next highest bidder or seller is, which is cool.
You won't be able to see who. It won't be like Tom in Nebraska.
Yeah, that would be cool though. I had thought that would be, pretty sick,
I think, dude, honestly, they should. I wonder if they ever will make stocks have like a blockchain kind of thing. I think it'd make it pretty obvious to see who's pumping shit.
Oh yeah, for sure.
I mean, you'd be able to find it eventually.
Yeah. And then
you wanted to go into placing orders, I think.
Yeah. And so that brings me to one of the next things that we always get asked, which is order types. Because a lot of people, again, same thing. You come in the market, you're like, all right, buy, sell, call it a day. And we will go into this more in depth in a few weeks. However, just for the sake of, really simple lingo, we'll go over order types. And so there are a bunch of different order types that you can use to buy and sell. And typically those, the amount of order types basically depends on your level of knowledge and experience. There's some order types that, I can't even say, there's like 15 different acronyms just inside the order type. And then of course you have your simple ones, which we'll go over, which is market. And what that means is that if you put in a market order, so let's just say that I put in a market order buy,
you're either buying the ask or you're selling to the bid.
Yeah. And so basically what that means is that it's just going to fill you at whatever is the best available price. So again, as I'm looking at Airbnb, if this was when the market was open and I did a market buy,
can't do these during after hours.
Well, that's what I said. If the market was open.
Yeah, no, I was just saying, just to clarify for you.
Oh, yeah. No, that's a good point. If the market was open and I was market buying Airbnb, the ask is currently 105.46. So that's where I would get filled at. Now, if between the time of me putting the order in and the order getting filled, the ask changes, then it would then jump. So that's sometimes if you're trading when it's really volatile, that can be the risk. You don't know exactly what price you're getting filled at, because you're just going to get filled at whatever price it can. It's kind of like whack-a-mole. The market orders like whack-a-mole. Like I'm just going to fill you at whatever price.
It could be there, it could be not.
Take it. Yeah, exactly. And same way on the sell side. And then you have limit orders, which limit orders, if you're starting out, are probably the way to go, because when you put it in limit order, if the bid or the ask or the price of the stock does not come down to that level, then you will not get filled, and therefore you'll have less risk on the table. So again, I'll kind of say that a little bit slower, and I'll give you an example. So let's just say Airbnb again. Let's just say the bid is, which it currently is 105.41, and the ask is 105.47. Well, if I put in a limit for 105.43, I'm not going to get filled right away because that's above the bid. That's above, wait, did I say sell or buy? Sorry, I forgot. I probably confused people. But if I put in I'll just restart. If I put in a Airbnb limit order buy for 3 shares, and I put it in at the bid currently is 105.41. So if I want to get it at a lower, better price, I'm going to put in 105.35. Now, the caveat there is that yes, it is in at a lower price. However, it doesn't necessarily mean that you have to get filled.
Yeah, just because you're offering that amount doesn't mean someone's willing to sell it at that amount.
Exactly. And so the stock price has to come down to that level to where the bid, that's the next step on the bid to get filled. And sometimes that doesn't always happen. But again, is that the good part about that is that you know what price you're going to get filled at for sure.
Yep. And obviously when we're talking about these types of orders, the thing we also need to talk about is times of orders. I know we just mentioned with limit orders with market orders not being able to do them in pre-market and after hours. It's kind of to make sure you're safe because a lot of times the amount of shares being sold then a lot less. You go to buy 1,000 shares, you may buy 500 of them at $1 and 500 of them at $60 just because no one's selling them. You got to make sure you do day plus extended or after hours, whatever your broker might call it when you're doing limit orders.
Perfect. And like I said, is that there are a few other different types of order types, and we do plan to go into those a little bit more in detail. But for again, this, it's only the second episode of Back to the Basics. So this is perfect. Just keeping it simple to market and limit. So the next one is that when you might look up a stock on, let's just say Google, it'll give you a few different things, and we're going to go over this. So you have, let's just say that you look up again, Airbnb. You're probably going to give a few different information points, which is going to be percent change, 52 high, 52 low, the industry, the sector, and again, as we just talked about, the bid, the ask, and the last price. And finally, the market cap. And so we'll go over all those real quick. When it refers to 52 high and 52 low, that is what the highest price it traded at over the last 52 weeks. And obviously the lowest price it traded at over the last 52 weeks. And the reason that this is important is because you'll be able to, it's really not, again, one of those black and white situations. It's just important because you'll want to know where that is in relation to the stock. So if I know that Airbnb was trading at $500, 52, its 52-week high is $500, and it's trading at 116 or 105, I'm going to want to know what that's all about. And I'm going to want to see, is there some reason why it's trading down here? And is this either a really good deal, or does it have more to, further to go down, and vice versa with the 52 low? And again, is that number is going to constantly change because, again, the 52 weeks ago today is not going to be 52 weeks ago yesterday. And so I think that's an important point. And then the next thing up is percent change. So this is going to be how much percentage points the stock has changed today. If you see, 1, 2, 3% with a plus in front of it, that's going to be how much it is green. How well it's doing for the day, and obviously minus is the inverse of that.
Yeah,
and
most of the time they'll be color coded as well.
Yeah, exactly. Yeah, Yeah. And even I think like Google does like the chart too, like not only the numbers, but I think like the chart. Yeah. So it's cool. And so that's really important, obviously. And then not only will you have the percent change, but you'll have the price change. So again, is that if Airbnb is up or down $1, that's going to be almost 1%. Where if SPY is up $1 or down $1, that's only going to be less than a 20th of a percent or 1/5 of a percent.
I'm still on the HKD, and it's on 5 days, and it's up $1,627, and it's up 3,143%.
Yeah, and so that's wild. So that's the 52-week high, 52-week low, percent change, and price change. We went over bid and ask. And then the last thing that we'll go over for when you kind of open up like a stock chart or you search up a ticker is volume. Now, this is key because as you'll find out, a lot of times you'll hear a lot of different traders say volume is everything. Volume precedes price action. And so what we mean by volume in really simple terms is how many shares the stock has traded. So HKD Friday had traded like 2.6 million shares. HKD today had only traded, I think, like 300,000. I want to say like 300,000.
Yeah. Let's see. I'm on the shit. Well, Google's not exactly the best one for checking this shit.
So it traded 350,225 shares. And like I said, is that Friday it traded like 2.4 or 2.6 million. So you can see that that's a pretty big decrease inside volume. Now, volume is there's a few different like subsections of volume. You have average volume. And that average volume is going to be based on, it's obviously going to be based on the average amount of shares traded during a certain period. So a lot of guys and girls like to look at the 90-day average volume, the 30-day average volume, and the yearly average volume. And that's going to give you, like I said, that's going to give you, just kind of like we talked about with the 52-week high or low. It's just going to give you like a subset or kind of like a baseline for where everything is at. And like I said, so if you see volume, you can just think amount of shares traded.
Okay, so other subsections of volume you want to talk about? Obviously, we just went over average volume. What other ones do you think are more important?
So as far as volume goes, like I said, is that the average volume is pretty important. And then the other thing that I think is really cool, and we'll go into this later inside a deeper episode, but kind of like the sizzle index and like volume boost, and all that tells is that, or relative volume for the day, and all that tells is kind of what the volume is on pace for the day and what the average volume is. And, so if you know that like a stock has potential news within the week, so let's just say it's an FDA candidacy, and all of a sudden its average volume is 1 million shares and it starts trading 5, 6, 7 million shares and everybody's buying this, you can know that somebody, you can kind of infer that people think that this is going to be good news. But if it starts to go up on very little volume, that can tell you, again, is that the difference between, let's just say that the average volume is 1 million shares. If it goes up 5% on 5 million shares, that a lot of people are buying it.
So you can kind of look at relative volume to see towards the end of the day what it's going to be, or can you look at it for more than just that day?
Yeah, you can look at it for more than that day. I personally like it for that day, or for that week, or even once the day is finished. Just because, like I said, is that it can kind of give. Because again, is that I can look at the same stock, and if they're both up 5%. The difference maker between if I think the difference between if I think it's a real 5% and kind of like a fluff 5% is going to be based on the volume. Like I said, is that if the stock usually trades 1 million shares and it's trading, 6, 7, 8 million and it's up 5%, I know a lot of people are buying it. But if it's only up on 600,000 shares and its average is about 1 million shares per per day, then I know that, people are buying it, but it's up a lot relatively to the volume.
All right. So now moving on from volume, we can kind of go into, I guess, different types of ways stocks can kind of get into the market. Obviously, during 2020, we saw a craze with SPACs. Everyone got in, and we'll go over those too. But I think one of the more popular ones, the word gets tossed around a lot, is an IPO. What's kind of an easier way to describe that for them?
So an IPO is initial public offering. And what this basically entails is if I were to bring my company public, then how it would work is that I would offer shares to the public at a certain price, or the broker that I choose would offer shares at a certain price. Now, a lot of times investors have difficulty getting into IPOs because the price might drive them up, and there's only a certain amount of supply at a certain amount of shares. So let's just take like SpaceX. When SpaceX becomes public, my hunch says that the amount of people that are going to want to invest in SpaceX is going to be more
a dickload.
Yeah, is going to be more than the amount of shares available, which will naturally push the price up. So when we hear and we talk about stocks it IPO'd at 14, but the first listed price is 19, that's because it was oversubscribed. And what I mean is that too many people wanted in on the IPO that it drove the price up. Just like inside the same token, sometimes you have an IPO price and let's take, I think FaZe Clan, their IPO price was 14. That day it dropped down to like 9 or 10. I don't know why that did that. But again, is that if an IPO is undersubscribed and not that many people want it, sometimes it'll drop off the IPO because investors or traders
probably has something to do with FaZe Clan's fans being the average age of 15 and not having a brokerage account. I don't know that.
Yeah, and might think that it's overvalued. That's pretty important.
All right, I think another good thing we can do, and we could do direct listings and SPACs as well. Just another way for things to kind of come onto the market. If we can kind of start with SPACs, it's a little easier before we go into the difference in direct listings and IPOs. I think a good way to describe SPAC is it's a special purpose acquisition company. It's the acronym for it. But essentially, it's just a shell company, a blank check company, and these companies want to come to market without doing an IPO or direct listing. They say, hey, we'll come through your thing. You'll change the ticker, make it cool for us. And can you kind of give the more intricate details of it than just hey, we're coming to market and we're going to join with this blank check company?
Yeah. So essentially, it's a really easy way, not an easy way, but
the easiest probably.
Yeah. The easiest way to get your company public. And this is why, if you guys don't watch it, quick little plug here for the
China Hustle.
Yes, thank you. Wow, you know me well. And so the China Hustle, if you guys never watched it, go back and watch it and look at 2008 reverse mergers. It's really interesting. However, SPACs kind of feels similar, and I won't spoil it for you, but it kind of feels like a similar way. And so this is from rebellionresearch.com. Many insiders and experts say that SPACs are just one step away from IPOs. This means that SPACs are riskier than IPOs. Studies have proven that the average IPO outperforms the wider stock market, but the average investor doesn't receive the same return in IPOs. According to experts, a small group of big performers steer the average performance. For the rest, the average IPO return is lower than the wider market. So if an IPO is lower than the average market and a SPAC is considered riskier, I'm going to go out on the land here and say that SPACs do worse than IPOs.
All right. Well, lastly, we have direct listings. Kind of similar to IPOs, but the main difference is how people get in them at the beginning, correct?
Yeah, so it's the same thing about how it is offered to the public. And so I will basically, a direct listing, is basically a process where the company shares become publicly traded. and they don't go through the formal IPO stage. Now, in a direct listing, the company does not issue any new shares. So again, if I go and sell my company through a IPO, then the broker, I'll tell the broker, listen, we have 50 million shares. This is what we'll list it at, etc. That's how the money is brought in. During a direct listing, the company does not issue any new shares, and it doesn't hire a broker or an investment banker to underwrite or promote the deal. So they only sell the existing shares inside the company. Now, again, this kind of is like where we go back to SPACs, to where this is a way that they can kind of just get on the market without having to go through the whole underwriting process, which some people are not fans of because they feel like it can be scummy and people can slip in there. And yeah, that's pretty much the main difference. And like I said, is that, you're basically selling existing shares instead of creating new shares, which you do with an investment banker.
All right. Well, okay. Let's get into the difference in different types of stocks when it comes to, how big or small they are. I mean, you always hear penny stocks bad, blue chip stocks good. I mean, we've all seen Wolf of Wall Street, but I think kind of to get into it, aside from just blue chip stocks, are they just the things that are on the S&P 500 and the ones that everyone knows? You have the Apples, the Microsoft, the Walmart, and then the penny stocks ones, just the ones you find in the back of Hustler.
Yeah, essentially, the blue chip stock is kind of like the family name, the one where, it's at this point inside its career, it would really need to take a lot for it to go bankrupt. But again, is that kind of restricts the upside.
So this is more of a generalization of the more specific,
yes,
like micro cap, mini cap, low cap, large cap, low float.
Exactly.
Where
exactly.
those actually have specific definitions of float.
Exactly. And most of the time they're trading, at above a 5 billion, I'll even venture out there and say above a $10 billion market cap. And that's kind of like, at least like the smaller threshold for blue chips. And like I said, is that, your blue chips are like your Apples, your Microsofts, your PSA, your AT&Ts. Yeah. Yeah.
Okay, and a few others, and these actually have specifics too, as opposed to just bull market good, bear market bad. I think it is what bear market and recession recession is 2 months in a row of bear market, right?
Yeah,
or 2 quarters.
Recession is 2 quarters of negative growth for the economy, and then a bear market is pertaining to the actual stock market, and that is when the market experiences basically a price decline of 18 to 20%. And that's on, at least minimum. And that's your bear market.
Damn,
and
dude, 20% I feel like is, yeah, wow, I was bear market way before 20%, dude.
Well, that's the thing, is that typically, it's typically, when they announce a recession or they announce a bear market, more times than not, the move down or the move down inside the market is typically, more than half over. And as far as the economy goes, it's almost done. Or, like the economy is almost close to bottoming out as far as, a recession goes.
All right. Are there any more stock jargies you want to go over before we dip out?
No, you know what? I think this was a good episode. I think, like I said, is that, there will be other times where we'll go further into lingos, but that's when it'll have to do more with the actual topic that we're talking about.
Yeah. And to everyone that's been listening to it for a while, we know a lot of this seems pretty redundant, but at the same time, if you have any friends you may have recommended that, didn't really understand the podcast because of all the jargon and stuff, maybe last episode and this episode, maybe a good time to let them know to hop back in. We'd really appreciate the referral.
Yeah. And then the last thing that we're going to start doing is starting Sunday, we are going to start taking a email question, call of the week kind of thing.
Yeah, we posted our email we told y'all what it was, team@penniesgoinginraw.com. We posted, we have a good bit of questions, and we're gonna start them up on Sunday, right?
Yep, Sunday we're going to start them up, and I think this will be a really cool way, so that we do, we talk about our performance in the beginning, we go over, back to the basics, and then at the end we take a question that might be a little more in depth, or maybe just someone that's.
And we can even do like three levels of questions where it's like a beginner, intermediate, and like a more advanced question. It's all at the same time depending on how long they are. We'll work with it, and we'll work with you guys, and we'll figure it out. So we'll see you all next week, on Sunday, and we hope you have a great rest of your trading week. Love y'all. See ya. Bye.
Pennies Going in Raw is a production of iHeartRadio. For more podcasts from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.